Rents are collapsing and it's getting worse every single month, which is changing the dynamic between tenants, investors, buyers, and sellers. So if you are looking to transact real estate or you're interested in real estate information, this is the video for you. We'll be talking about why rents are falling and where they're falling so much so fast. And now tenants have the power again. Let's dig into why. Honestly, investors and sellers are kind of freaking out at this point. Number one, rents are falling, and this is actually causing the number of years that renters are staying in their house to be longer. We saw this massive run up in 2020 in terms of the number of years that people are staying. Look at this all the way back in 2005. We have people who are choosing to rent for a longer period of time. A lot of that is due to the affordability crisis, due to interest rates rising, due to prices simply outperforming wage growth, which is only up about 30% over the last decade. Meanwhile, housing prices and rents are up 100%, in some cases more than 100%. This data comes from the National Association of Realtors, and this is a big red flag for what is about to happen next. And as we see, because of this affordability crisis, people who are renting and want to buy are completely priced out. This comes from ReVenture's demand index. You can see that during 2020, we saw a massive amount of demand. Obviously, during the mid 2000s, we saw a massive amount of demand, and it just completely plummeted when real estate mortgage rates started moving up. In March of 2022, we saw that the Fed started to raise rates, and then boom, the demand dropped because we live in a payment economy. See, people aren't dumb. The renters can do the math and figure out I could either rent this house or I could buy one that's similar and have a similar payment and start getting equity pay down, start getting the mortgage interest tax deduction, things like this that make it financially make sense to buy a house. Well, now that it's flip-flopped, renters are sidelined and they're just staying on the side, waiting for prices and interest rates to come down. Renters are going to consider other options. And unfortunately, because rents are coming down, it's causing renters to negotiate even more and cause prices to come down and make it less affordable to buy a house when you look at the opportunity cost. So it depends on who you are. If you're an investor, it's a really scary time to be an investor and have a lot of properties. If you're a renter, it's a great time because you finally, after years of pain, have the power back and you can negotiate. This is where demand is crumbling. You can see this on this ReVenture app. This is how it's broken through. These are components of the ReVenture app home buyer index. Google searches to buy a house are falling. Pending sales are falling. Buyer sentiment is falling. In mortgage applications, they're off of the bottom, but they're starting to fall now that we have this new crisis with Iran and the oil situation. It could get a lot worse from here. I know a lot of people think we're just going to grind along the bottom here and there's going to be more transactions. There's no guarantee in this market. It has been so volatile, and how this plays out after this massive credit bubble that we've created over the last decade or so, how this plays out could be really painful. So it depends on what the Federal Reserve decides to do from here. If we're going to have some sort of long, slow type of market that just changes slowly over time as wages eventually keep up, who knows what's going to happen with AI, or we're going to have some sort of credit crisis and it could crack and we could see prices really start to come down. What's interesting is we're already starting to see the pain in the multifamily space and the single family rental space without some sort of massive credit crisis at this point in time. So here's what we're seeing in Florida for rent prices going down. Now, rents for apartments have been down for 3 years almost. This is across the nation, but for Florida, it's getting hit. Look at this. Fort Myers down nearly 20%, Crestview, Northport, Pensacola. Where I'm at in Jacksonville, we're down 9.9% from the peak in 2022. I can tell you in some areas, we are also down 20%. So I think this data is really interesting. It's from August 2022 to March 2026 from apartmentlist.com. I can tell you that's for apartments. There is a lot of inventory out there because there's accidental landlords. People try to sell their house. They can't sell it. They turn around, they change their property into a rental, and it just doesn't rent to cover the expense of the mortgage, or it takes 90 days to fill the vacancy until the seller wakes up and realizes the math no longer makes sense. It either goes to short sale or it goes back into selling into the market at a lower price. And now they're chasing the prices down. The buyer power is there now. The rent power is there now. You have the ability to negotiate with sellers as long as it's not a perfect condition house and there's not too many of them around. Okay. So we are still seeing mint condition properties in unique locations, unique views sell like hotcakes. Same with rentals. If the rental is perfect and there's not a lot of them around, they still go very quickly if they're in high demand areas. The problem is that Florida overbuilt. There was so much speculation. The builders went crazy and they thought the demand would continue forever, and it just didn't. And actually, I'll show you an example at the end of this video where there's people who are leaving a major city in Florida that you never would expect happen, and it's going to cause a massive issue for the housing market. It's very challenging now that these markets are overbuilt and they expected this peak demand to happen. Now they're actually seeing people leave the area for various reasons. And so let's dig into why that is. So stay around until the end and I'll show you what city that is. But net domestic migration shift is one of the biggest problems that we're seeing. During the 2020 to 2022 time period, we saw this massive spike of people relocating to Florida. They wanted no state income tax. They wanted sunshine. They wanted to be outside. This is the same with Texas. But once this period was over, we see the demand completely drop. The speculators are gone. The movement is gone. We pulled 10 years of demand forward and had that all exist within 3 years. You can see that here. And now we're mean reverting, going back to normal. And it is a problem for the people who bought from 2022 to 2025 at the peak prices in these specific states. So people are now not relocating. They're not coming here. And in some cases, they're actually leaving. And this is a massive problem. So here's the city that we're tracking very closely. It's Tampa, Florida. Look at domestic migration. We had this massive spike in the run up with a bunch of speculation in 2004, 2005. Then we have this similar type thing that happened right after we hit the bottom. We saw this tons of migration to Florida, mostly from the baby boomers and wealthy people. And then we're seeing this spike downwards. This is what we talk about. Florida has massive boom bust periods. A lot of these cities, it is not like the rest of the country where we just have slow, steady Eddy. This is a part of the country that's really reliant upon domestic migration and international migration. And international migration across Florida is down 70% from the peak. Tampa is holding up a little bit better, but we are mean reverting here. You can see domestic migration actually has people leaving Tampa now, which is crazy. And also one of the other issues is that this birth to death rate ratio, people are dying in Tampa faster than they're being born. So they're losing residents from the birth decline. And we're also seeing it from domestic migration. And it could get worse as time goes on. The market should adjust, and we should see prices and rents come down. That would make it more attractive for the next generation to move there, hopefully more jobs in Tampa, etc. But this is something that we could see across various cities in Florida, and it could make it for a really challenging housing market, especially, again, for the people that bought in those peak price years, 2022 to 2024, especially around new construction areas. This is another sign of the rental market that's having issues. This is for apartment vacancies, but when there's apartment vacancies, there's often single family vacancies as well. You can see that the vacancy got down to 2.4%. Phenomenal. And now we're going back to normal, a little bit worse than normal, up to 8.7% vacancy. You can see historical for Tampa is around 6.4% vacancy. So we're above that now. So, and this could continue for quite some time until we see prices start to make sense again for the next generation. And I think this is a big red flag. And for the policymakers and the investors who are in Tampa, you need to be paying attention to this information because it impacts your investments. This is Cape Coral. This is just another example of what's coming. 25% rent cut in Cape Coral from $16.95 all the way to $12.72. This is rental market deflation from median apartment rents in this area in Fort Myers from apartmentlist.com. This run up here happened because of a temporary demand shock. So there's always this narrative out there of housing shortage. There wasn't a housing shortage. We didn't have a shortage before 2020. We had a normal market with 6 to 8 months supply. Okay. The story of the narrative of a shortage is not real. What we had was a demand shock from high cost, high tax areas into our state. And they gobbled up a ton of real estate and they started speculating on real estate. And then the builders went crazy and just overbuilt multifamily, overbuilt single family. And now that the migration has been pulled forward and it all happened, now we're seeing everything correct back down to all the way to the 2021 levels. And we could see this. I honestly think we could get back to 2019 levels from rents and in some circumstances around new construction prices. I'm not sure if it can go much further than that. There will be a backstop where investors start to come in and say, hey, I'm going to start buying this up. But we're in for some distress, especially for those years where people were buying rental properties at peak pricing. Obviously, if you buy a rental and you're expecting rents to continue to go up 4% at a 16.95 rental rate, and now it's renting for 12.72, you are underwater big time on your rental. And this is true again, although this is for apartments and single family rentals are very correlated, especially when you look at the supply, and also because they compete against each other. So young people will go around and say, oh, do I want to get an apartment with new amenities, or do I want to get a single family house, maybe have a pet, maybe have a kid, something like that. They decide between the two based on their individual circumstance, but more supply in general is more supply. That's my opinion. That's the way that I've seen it in my career. Now, as active inventory stacks, so this is the thing, we're starting to see more inventory slow down. It's not selling as much. You're starting to see it kind of trickle up every single month. We're seeing list prices of houses coming down. Now, obviously, if rents are coming down too, you're going to need to see prices come down even further to make the payment competitive with the rent. So in 2026, we are behind 2025 and 2024 list prices. This should come as no surprise to anybody. I expect us to be behind the curve as well. And this is very healthy for the market. This is for the national market, not just for Florida, but I think this is a really good thing. We need prices to correct. Obviously, 60% increase in price in 3 years is not sustainable long term. But here's a factor I really want you to understand. Real estate is micro, okay? So markets are fragmented. This is active inventory as of February 2026. Some markets have less inventory versus 2019, and some have more. As you can see, there's certain areas in the Northeast that have less inventory, and there's areas in the Sun Belt area that have more inventory. Look at this. Denver has 49.4% more inventory than it had in February of 2019. But there's certain areas, look at Massachusetts, it has less inventory because they couldn't build there. There's certain areas like Jacksonville, Florida, that have 31% more inventory. And so every market is very different. If you need a top agent in your market to help you guide you through this, we're happy to let you know. But obviously, this all impacts the rental market. And every one of these not only has more active listing inventory or different active listing inventory, they all have different rental markets. The market that we were talking about before was Florida, which is getting creamed. Obviously, Texas is having a really hard time as well. Georgia, you were starting to see massive slowdown in Atlanta. And we're even seeing issues in North Carolina and South Carolina, these speculative markets that just their prices just made no sense whatsoever and have just completely spiked, and now they're coming back down. But one of the things that we're seeing with these speculators, they've stopped buying. They've stopped buying. They're scared. They're actually trimming their portfolio. There's word through the grapevine that these institutional investors are starting to trim their portfolio and might be selling more of their portfolio moving forward. But this is a huge issue because their returns, as these rents come down, the returns aren't as good, and it doesn't make sense for them to buy rentals anymore. It'd be a better purchase in a lot of cases just to buy the treasury bills and still get a 4.7% rate of return, help cover the cost of inflation and keep the value of their money. But this is a massive story here of why investors stop buying houses, and it's going to probably be a case for a longer period of time. The only reason you buy a house is if it's in distress, it's off market, you're not paying market price, you can get a certain amount of equity, maybe you do a little bit of value add or you chop it up. There's a lot of different ways to make real estate in any type of market, but just going retail and trying to buy an investment property no longer makes sense. Did it make sense in the past? Yes, because we saw the institutional investors do it all the way up until 2022. They bought tons of stuff that was on the market as long as it fit their buy box. Now that story no longer makes any sense. And of course, that's why sales are down. You can see 2026 is lagging 2025. So the market velocity of transactions is falling, which is the first indicator, right? You see transactions slow down, you see the listings stack, you see the price cuts come in, you see the rent cuts come in, and all of a sudden you're on a cycle downward. And that's what we're starting to see. We were really excited because we saw rates go down and then they spiked right back up after the start of the Iran war, which is going to really slow the market. So I think we're going to see a weak, busy season. Probably April and May are going to be a little bit rough because of what we're seeing right now, especially if it's not figured out in the next few weeks. Here's what we're seeing with the oil spike. Huge jump which is huge supply side inflation, not the type of inflation that you want to see if you're an investor. This takes money out of the market, dries up liquidity versus, demand side, which would be, the money printing from the Fed. This is just taking money out of people's pockets and it's turning it into crude oil prices that have skyrocketed all the way from $60, $55 up to 103 today. And there's really not any good news on the horizon that I can see. And then could be a really huge problem for real estate moving forward. About 92% of the time that there's an oil spike like this, there's a recession that follows, and it does carry over into the housing market. And obviously, this is causing the mortgage rates to go up. You can see mortgage rates have spiked. We're up to 6.62% on the 30-year. That's if you have 20% down in good credit. Obviously, a lot of people don't get that great of a score. That's just if everything looks good to you, to the loan officer and to the bank. So this is what's causing. We just had the Iran war begin. We were doing really well with rates coming down, and then boom, we had the Iran war start, and the mortgage rates surged. So I've got a lot of questions on X about what's going on, so I'd like to address it here. So this is a post I did. It said the biggest mistake buyers are making right now, thinking prices have already adjusted to 6.5% rates. They didn't. So people are saying, well, there's blood in the streets right now. That's not how it works. It takes years for this to play out. In many markets, we are still pricing real estate as if rates are 3%. The gap just hasn't closed yet. The sellers have not capitulated and take the price down enough for it to make sense for buyers to come back in. That's why we're seeing the velocity of transactions slow. So people are saying, well, I can get a deal. The deals are not yet. We haven't even barely felt pain yet. The pain is when the liquidity dries up and people have to fire sale their assets. Okay. So we're not even close to having any sort of pain. And just remember, real estate is liquid. It can take 5 to 10 years for this narrative to play out with either a slow decline or maybe perhaps a faster one if the oil prices stay elevated for a long period of time. Now, this is another great post that's the math broke. You can rent the same house for $2,500 or buy it for $4,000 a month. We've seen this across the board. This is what I was talking about in the beginning. It's so relevant for renters. Buyers aren't stupid. They're waiting. They're saying, why? I can rent that house for $2,500, take that $1,500 of saving and put it into the stock market and not have to deal with any of the repairs. Or I could buy that house for $4,000 a month and have to deal with the repairs as well and all the maintenance, like all the expenses that go with owning a home. So I don't think the buyers are stupid. That's why the velocity of transactions are down. The middle class is what really drives the housing market. A lot of the sales, especially because the investors have backed off. So this is where it's going to happen. And real estate's priced at the marginal purchase and sale. So we could see prices come down quite significantly here in the Sun Belt. The Northeast isn't quite the same. They have a little bit different of a setup, but they are struggling. There are certain things that are starting to slow down big time up there. So I'd love to hear from you. Will housing hold up this year? Will it go negative? I believe fully, especially with the Iran war, that it will go negative. It'll continue to weaken moving forward. It's going to be very much interest rate driven. We can tell when interest rates come down, there's a flock of buyers. The good thing is the demand is there, but they're just not willing to pay these prices. They are competing against the rental market, and the rents are coming down quite dramatically. So I'd love to hear from you. What are you seeing on the ground in your market? Tell us where you're from. Drop me a comment and a like. I appreciate you guys. And I will be here on Friday at 12 o'clock to answer any questions. If you're looking for a top real estate agent in your market, I can help you out. If you're looking to sell your investment property, you can reach out to me. I answer every single email. You can shoot me an email. I'd love to connect with you and hear what's happening in your world. Thanks for watching, and I'll see you next time.